Purpose of the Financial Statement Analysis Framework. A structured framework for financial statement analysis helps analysts evaluate a company consistently and systematically. The framework begins by identifying the purpose of the analysis, such as equity valuation, credit assessment, performance evaluation, or strategic decision-making. Analysts then gather relevant information from financial statements, footnotes, management discussion and analysis, industry reports, and other disclosures. The next step involves assessing the quality of financial reporting and identifying accounting choices that may affect comparability. Finally, analysts evaluate profitability, cash flow generation, asset efficiency, liquidity, solvency, and risk. A disciplined analytical framework improves decision-making by ensuring that conclusions are based on economic reality rather than isolated financial metrics. Evaluating financial reporting choices and adjustments. An important component of the analytical framework is identifying accounting methods, estimates, and assumptions that influence reported results. Different accounting policies can significantly affect earnings, assets, liabilities, and financial ratios, even among companies operating in the same industry. Analysts must evaluate whether management's accounting choices are conservative, neutral, or aggressive. Common areas requiring adjustment include revenue recognition, inventory valuation, depreciation methods, pension assumptions, lease accounting, and fair value measurements. When significant differences exist between firms, analysts often restate financial information to improve comparability. These adjustments help create a more accurate representation of economic performance and reduce the risk of drawing incorrect conclusions from reported financial data. Understanding earnings sources. Evaluating earnings sources is essential because not all earnings contribute equally to long-term value creation. Analysts separate earnings into recurring operating earnings, non-recurring items, financing-related gains and losses, and unusual or one-time events. Core operating earnings generated through the company's primary business activities are generally the most sustainable and therefore most relevant for forecasting. Non-recurring gains from asset sales, restructuring adjustments, litigation settlements, or accounting changes may temporarily inflate profitability but often have limited predictive value. Understanding the composition of earnings allows analysts to distinguish between sustainable performance and temporary accounting effects, resulting in more reliable forecasts and valuation estimates. Assessing earnings performance and sustainability. Performance analysis focuses not only on the magnitude of earnings but also on their persistence and quality. Sustainable earnings are expected to continue in future periods and therefore provide a stronger basis for valuation. Analysts evaluate trends in revenues, expenses, margins, and profitability while considering industry conditions and competitive dynamics. Particular attention is paid to the relationship between earnings and operating cash flow because earnings supported by strong cash generation are generally considered higher quality. Analysts also assess whether profitability improvements result from operational efficiencies, market expansion, favorable economic conditions, or temporary accounting adjustments. Understanding these drivers improves the reliability of future earnings forecasts. Analysis of the asset base. The asset base represents the resources a company employs to generate future earnings and cash flows. Evaluating asset quality and composition helps analysts understand operational efficiency, growth potential, and risk exposure. Important considerations include the proportion of current versus non-current assets, tangible versus intangible assets, and operating versus non-operating assets. Analysts assess whether assets are recorded at values that reasonably reflect their economic benefits and whether impairment, depreciation, or valuation assumptions are appropriate. Significant concentrations in goodwill, intangible assets, or illiquid investments may increase uncertainty regarding future performance. Asset analysis also provides insight into the company's strategic priorities and competitive position. Evaluating asset efficiency and resource utilization. Asset efficiency measures how effectively management uses company resources to generate revenue and profits. Common metrics include asset turnover, return on assets, inventory turnover, and receivables turnover. High efficiency often reflects strong operational management, effective asset allocation, and competitive advantages. Conversely, declining efficiency may indicate operational challenges, overinvestment, deteriorating demand, or ineffective resource utilization. Analysts compare efficiency measures across time and against industry peers to identify strengths and weaknesses. Understanding how assets contribute to earnings generation helps determine whether reported profitability is sustainable and whether future investments are likely to create shareholder value. Asset efficiency is therefore a key component of performance evaluation. Capital structure and financial risk. Capital structure refers to the mix of debt and equity used to finance a company's operations and investments. The chosen structure influences profitability, risk, flexibility, and shareholder returns. Debt financing may enhance returns through leverage, but also increases fixed obligations and financial risk. Equity financing provides greater flexibility but may dilute ownership and reduce return on equity. Analysts evaluate leverage using ratios such as debt to equity, debt to assets, and interest coverage. They also assess the maturity profile of debt, covenant restrictions, refinancing needs, and access to capital markets. A well-balanced capital structure supports growth while maintaining acceptable risk levels. Integrating earnings, assets, and capital structure analysis. The ultimate objective of financial statement analysis is to integrate earnings performance, asset quality, and capital structure into a comprehensive assessment of value and risk. Strong companies typically demonstrate sustainable earnings, efficient asset utilization, and prudent financing policies. Analysts combine profitability measures, asset-based metrics, leverage indicators, and cash flow analysis to develop a holistic understanding of financial health. Adjustments may be necessary to improve comparability and remove distortions created by accounting differences or unusual transactions. For CFA candidates, mastering this integrated framework is essential because it forms the foundation for valuation, credit analysis, portfolio management, and investment decision-making across a wide range of industries and market environments.